Have you ever looked at your paycheck and wondered if there's a way to make your money work harder for you? What if I told you that with just $25 a week, about the cost of a few coffees, you could potentially build a passive income stream of $5,000 per month? Today, I'm going to walk you through a realistic blueprint using one of the most respected dividend ETFs on the market. SCHD, the Schwab U.S. Dividend Equity ETF. According to a recent survey, 63% of Americans are living paycheck to paycheck. Yet many don't realize that small, consistent investments can compound into significant wealth over time. That's the power of dividend investing, and specifically why SCHD has become a cornerstone for income-focused investors. In this video, I'll break down exactly how you can turn a modest weekly contribution into a substantial monthly income stream, using real numbers and practical steps that anyone can follow. No financial jargon, no unrealistic promises, just a straightforward path to potential financial freedom. Before diving into our blueprint, let's understand what makes SCHD special. The Schwab U.S. Dividend Equity ETF, SCHD, tracks the Dow Jones U.S. Dividend 100 Index, focusing on high-quality companies with strong fundamentals and consistent dividend payments. What sets SCHD apart from other dividend ETFs is its careful selection criteria. To be included, companies must have paid dividends for at least 10 consecutive years, showing remarkable consistency. The ETF also screens for financial strength, looking at metrics like cash flow to debt ratios and return on equity. The result? A portfolio of approximately 100 stable, mature businesses with histories of rewarding shareholders. We're talking about companies like Coca-Cola, Home Depot, and Verizon, businesses that have weathered economic storms and still manage to share profits with investors. SCHD currently yields around 3.5% annually, significantly higher than the S&P 500's average yield. Add in the potential for dividend growth and price appreciation, and you can see why this ETF has become so popular for income-focused investors. But perhaps what's most appealing about SCHD is its remarkably low expense ratio of just 0.06%. This means for every $1,000 you invest, only 60 cents goes toward management fees annually. Compare this to actively managed funds that might charge 1% or more, and you're keeping more of your hard-earned money working for you. Remember, dividend investing isn't just about current income. It's about building a growing stream of passive income over time as companies increase their dividend payments year after year. Now that we understand what SCHD is, let's explore how a simple $25 weekly investment can grow substantially over time. This strategy isn't about getting rich quick. It's about harnessing the incredible power of consistency and compound growth. First, let's do the math. $25 per week equals approximately $1,300 per year. While that might not sound like much, don't underestimate what happens when we combine three powerful forces: regular contributions, dividend reinvestment, and time. When you invest in SCHD, you'll receive quarterly dividend payments. During the accumulation phase of our blueprint, instead of taking these dividends as cash, you'll reinvest them to purchase additional shares. This is called a dividend reinvestment plan, or DRIP, and it's a crucial accelerator for your wealth-building journey. Here's what happens. Every dividend payment you receive buys more shares, which then generate more dividends, which buy more shares, creating a virtuous cycle of compounding growth. This is how Einstein's eighth wonder of the world, compound interest, works in your favor. Let's look at some realistic projections. Based on SCHD's historical performance, which includes both dividend payments and share price appreciation, a reasonable long-term total return expectation might be around 8 to 10% annually. At a 9% annual return, your $25 weekly investment would grow to approximately $7,500 after 5 years, $20,000 after 10 years, $60,000 after 20 years, $180,000 after 30 years. Of course, past performance doesn't guarantee future results, and the market will fluctuate. That's actually good news during your accumulation phase. When SCHD's price temporarily drops, your fixed $25 weekly contribution buys more shares, a concept called dollar-cost averaging. This naturally helps you buy more shares when prices are low and fewer when prices are high. The beauty of this approach is its simplicity. Set up automatic transfers from your checking account to your brokerage account. Enable dividend reinvestment, and then let time do the heavy lifting. No need to time the market or stress about daily price movements. As your financial situation improves, you'll want to accelerate your journey to that $5,000 monthly income goal. This section explores how to strategically scale up your investments over time. Start by identifying funding triggers, specific financial milestones that signal you can increase your weekly contributions. These might include receiving a raise or promotion, paying off high-interest debt, completing major financial goals like building an emergency fund, reducing major expenses like finishing student loan payments. When these triggers occur, consider increasing your weekly contribution by at least 50% of the newly available money. For example, if you receive a $100 per week raise after taxes, allocate at least $50 of that to your SCHD investment. Another powerful strategy is to make lump sum contributions whenever possible. Tax refunds, work bonuses, gifts, or side hustle income can significantly boost your portfolio's growth trajectory. Even a single $1,000 lump sum contribution can shave months or years off your timeline to financial independence. Let's visualize the impact of scaling your investments. If you started with $25 weekly but increased to $50 weekly after year 5, then to $100 weekly after year 10, your portfolio value after 30 years could grow to approximately $350,000 instead of $180,000 in our previous calculation, nearly double. Remember that SCHD's management team regularly reviews and adjusts the portfolio, ensuring that your investment remains focused on high-quality, dividend-growing companies. This built-in quality control means you can concentrate on your contribution strategy without worrying about frequent portfolio rebalancing. As your investment grows, you'll notice an interesting psychological benefit too. Watching your dividend income increase quarter after quarter provides tremendous motivation to continue and even accelerate your investment plan. There's something uniquely satisfying about seeing companies deposit money into your account simply for being a shareholder. Now let's address the ultimate goal, generating $5,000 monthly, $60,000 annually in dividend income. How much would you need invested in SCHD to reach this milestone? With SCHD's current dividend yield of approximately 3.5%, you would need a portfolio value of around $1.7 million. $60 000 divided by 0.035 equals $1,714,285. That's a significant sum, but remember that we're building this portfolio over decades, not overnight. Based on our earlier calculations, you might be wondering if this goal is realistic. The answer is yes, but it typically requires a combination of these factors. Increasing your contributions over time, as we discussed. A long investment horizon, 20-30 plus years. Dividend growth, companies in SCHD raising their payouts annually. Some degree of share price appreciation. Let's examine dividend growth specifically. Many companies within SCHD have histories of raising their dividends by 5 to 10% annually. This means that even if you never added another dollar beyond your initial investments, your income would likely still grow over time. For example, if the companies within SCHD increase their dividends by an average of 6% annually, a $1 million portfolio yielding 3.5%, $35,000, today would generate approximately $62,500 in annual dividends after 10 years, without you adding a single additional dollar of capital. As you approach your financial independence target, you'll want to shift from reinvesting dividends to receiving them as cash. This transition from wealth accumulation to income generation is straightforward with most brokerages. Simply disable your dividend reinvestment plan. Some investors choose a hybrid approach during their final years of accumulation. They might take 25% of dividends as cash while reinvesting the remaining 75%, gradually adjusting this ratio until they're taking 100% as income. Remember that $5,000 monthly is just a target. Many find they can live comfortably on less, especially if major expenses like mortgages are paid off by retirement. The beauty of this blueprint is its flexibility. You can adjust your target based on your specific needs and circumstances. This explanation showed that building significant dividend income isn't about luck or a huge salary, but about consistent action over time using investments like SCHD. If you found this explanation of how small, regular investments can become meaningful passive income valuable, please like this to help others find it. Subscribe for weekly practical financial blueprints that break down wealth building. What part of this blueprint resonated most with you? Comment below with what you found most helpful or any questions. I personally respond and might use your questions for future videos. Remember, your financial journey starts with a single step, in this case just $25 a week. Take that step today, stay consistent, and watch your financial future grow with each dividend payment.